with using the mic. Give her the mic. I hope are you shy about using the mic? Then we have to force you to use the mic. You're going to tell us what is the golden rule of hedging.
So the net of the initial adjusted position, underlying position.
Don't try to memorize or read. Just give me just tell me what you have understood in plain English.
That the position must remain between.
What position? What position? Only the underlying position. And the hedge position. So what do we call that for yeah, total position or net position. Yeah, okay. So then as long as it doesn't matter whether you use the word total position or net position, as long as you clarify that it is the sum of the hedge position and the underlying positions. Okay, is this clear? All right. Yes. Go ahead.
It must remain between 0 and the amount of the initial hedge.
Initial what position? Initial what position? Initial underlying position, right? Because this is your underlying position. These are your underlying for any particular market. Let's say we continue to look at the oil market. Okay, since we have the oil chart up, your oil position is 25,000. Okay, so when we say initial underlying position, the text is all in your notes. You have access to the notes. There's no need for you to write, but important for you to just understand the concept. You see, it's shocking that so many people are not able to answer this question, right? It's a very simple concept that the total position that you have, hedge plus underlying, total must not exceed 0 and the amount of the initial underlying position. And when we say initial underlying position, okay, you start with 25k. That initial is to be understood as the hedging period is starting and restarting every second, which means what that means is essentially that all that it means is, suppose you start the hedging program with 25,000 barrels. Then after 3 months, the sales team informs you that they have sold 10,000 barrels to Japan. Okay, the contract is sealed. Delivery has not taken place because you remember transaction dates and settlement dates. The settlement date for the contract may be three months later, but the price risk on that 10,000 barrels has been removed because the transaction date is over. They have sealed the contract with Japan. The delivery will be 3 months later, but the price is locked in. Remember, just like all these futures prices that you're seeing here. These futures prices. This is like for this. This is for February 26, 2020. But if you sell at this price, if you sell gold at you sell the Feb contract at 1481, that essentially, if you imagine, especially this is a forward contract because the discussion we are having is regarding selling 10,000 barrels to Japan. That would be a forward contract, not a futures contract, because it's an OTC contract, right, between this company Magma and the Japanese buying team, right? So if it's a forward transaction, we assume that it has the same price, okay, the futures price. So if you're selling gold, let's say you're selling oil at this price, the price is locked in, but the settlement will happen 3 months from later, from the transaction date. Is that clear? Everyone remembers transaction dates and settlement dates? They need not be the same.
Yes, sir.
Yes, everyone is clear. You can have all kinds of different settlement dates, right? So you can even go in the foreign exchange forward markets. You have transactions which go even like 5 years, 10 years. For 10-year forward rates also you can get, all right. And swaps, when you do swaps especially, you can go out very far, long-term swaps. So there's no limit really theoretically there's no limit on settlement dates, on how far the settlement date can be from the transaction date. This is clear. So it means that when the accountants do the inventory, let's say the moment on day 0 you conclude on day 1 you conclude the contract with Japan, all right. On day 5, let's say the accounts have to be prepared, because it's a 3-month contract, so the settlement date is 3 months later, so the shipment has not yet occurred. Are you following? So there will be 2 sets of books. The hedging team needs to prepare a different set of accounting books, because the accountant will show the inventory as 25,000, because that 25,000 is still lying in storage. Is everyone following?
Yes, sir.
The traditional accountant, the CA types, they will show the accountant, they will still show it because 25,000 barrels is still in storage. But for the hedging team, now the unhedged position has changed to 15,000, because 10,000 already has been, the price risk has been removed by doing a sale contract with Japan. you have removed the price risk. So if you take the oil contract, okay, so if you're taking the Feb 20 oil contract, let's say you sell it for this period, so you sold it at 60.81. Now the price is locked in on those 10,000 barrels at 60.81. So delivery will occur later. Is this clear to everyone?
Yes.
This we have discussed many times, that there is such a thing. That's why we have these concepts called transaction dates and settlement dates. That the settlement date need not be the same. It could be anywhere. It could be 5 years out, 3 years out, 6 months out, anywhere. Depends on the deal between the parties. This is clear? Everyone is clear? Okay. All right. So that's what we are saying. So when we say, so coming back to this point of why did we have this discussion? To understand the meaning of the word initial. If you go back to your notes, this is where we have this. I've put everything into this. I've sort of modified this a little bit from and the golden rule of hedging. If we can just click here and go through. Right. So project goal, everything, all this stuff we have already discussed, but we're just recapping on the golden rule of hedging. So the net of the initial underlying position. By this initial, what is the meaning of the word initial? It is to be understood in the context of as if you're constantly updating the balance sheet with fresh information from the sales team. If any amount has been hedged, if any amount has been sold, then it is no longer to be considered as unhedged inventory. Is this clear? Everyone understands what I'm saying? I think some people maybe are not able to understand, but you're not asking questions. Is everyone clear about what I'm saying?
Yes.
So you start out by, so when you start out, the way the golden rule of hedging will work, because of the interpretation of the word initial, is when you start out, you're dealing with 25,000 barrels or 25 contracts of unhedged inventory. Okay, so I'll avoid saying 1,000 every time. So you're starting out with 25 contracts of unhedged inventory. After say 2 weeks, you get information from the sales team that they have sold 10 contracts to Japan, right? So 10,000 barrels goes off. So now your fresh updated underlying position will now show as only 15,000. Although for the purposes of the accountant, the balance is still going to show 25,000 in inventory because that is in storage. But because you're the hedging team, you're only concerned with market price risk and credit risk and things like that. Okay, so therefore in this case you're mainly concerned because you can't manage the credit risk on this transaction. Okay, so you take this and you just manage the market risk on this, and therefore you are going to treat this as the initial underlying position will now change from 25,000 to 15,000. Is everyone clear about this? This is what it means, right? So that you understand in your project, this problem, this nuance will not come into play, because in your project the underlying position is never going to change. Okay, just to keep things simple, we are not going to change it. But you should be aware that in real life, when you're managing risk for a corporate treasury, you will have underlying positions because the business keeps going on, right? If you're managing, let's say, for a gold mine, if you're managing risk for a gold mine, they will keep on, the stuff will keep coming into inventory, the physical inventory will keep piling up, but they'll also keep doing sales. And when they keep doing sales, you have to adjust your unhedged inventory position. Is everyone following what I'm saying?
Yes.
Right? So you have to understand this nuance. In your project, you will not face this problem because I will not change the underlying positions. But in real life, you have to be aware that this is what the initial underlying position means. You have to continuously update the balance sheet with fresh information on what amount has been sold. If it's been sold, then the price risk has been removed, because now you only have credit risk. If Japan does not honor its contract, then only then you have a problem. Okay, but in this case you can't manage the credit risk. It's to be managed between the sales team and the sovereign, Japan as the sovereign. Okay, so is everyone clear about this, the golden rule of hedging?
Yes, sir.
Some of you were not clear. Okay, so always mention this amount, that understand this. So there are some key concepts, how to study the concepts. I'll just give you an idea about how to study the concepts. Right. So here you see this is why Mehak was getting, so this is one of the reasons why I took out your notes in the first class, in the first course, because I noticed that even the more serious students are just mechanically mugging up the notes and they're not able to internalize the concept. The concept is not clear. From the way you answer, I can figure out whether the person has understood the concept or not. I was able to sense that people are actually just mechanically memorizing the text and just blurting it out. Okay, but essentially what we need you to do is you need to understand it yourself. Okay, whether you think in Hindi or you think in some other language, but you make sure that you understand in your own head, and then you express it. And your English, we're not penalizing you for wrong grammar or something like that, right? You have to be able to convey the idea that you have understood. So the basic idea is that you have this concept of a total position or net position, okay, which is the underlying position plus the hedge position, and the total is what you monitor all the time, and you monitor it against the initial underlying position and zero. So you have these two bounds. Okay, you can't go below zero and you can't go above the initial underlying position. And the idea that the initial underlying position has to be adjusted by, it has to be updated with any information which gives you, which sheds fresh light on what is the total amount of the underlying position. Like a sales team telling you that some amount has been sold, that means you need to update these figures on the unhedged inventory. Is this clear? Everyone is clear? Okay. So that's what we were discussing. So I put some of these things in your, this is also in your calc file. You can see the topics that are being covered. So hedging logic we have already covered. This is already in your notes. I'll just quickly run through it. So I put everything, so you'll find it separately also in, so your project goal that we have already discussed, I'm not going to repeat that. Okay, essentially you have to maximize your hedge P&L by taking views on the markets, because the underlying position P&L you can't do anything about. It's going to just change based on market price movements, but you have to manage your hedge P&L in such a way that you can offset the losses, so your total P&L will be maximized. Alright, so the procedure, basically all this stuff is already written here. Okay, we already know. I've given you the example for the long side. You can change it around for the short side. I'm not giving both the examples. Alright, all this stuff we have already discussed. Static, dynamic hedging programs, everything we have discussed. Okay, so now we'll just briefly discuss, is this what I have here? Yeah, hedging for speculators. Now we are going to go, and so is everyone clear so far? Any questions? Okay. So now hedging for speculators, we are just trying to understand this. So the point is that this framework that you have understood now, this concept of underlying position plus hedge position, you have these two, okay, underlying position and hedge position, these two positions, right? And the idea that the hedge position offsets the underlying position. Is this clear? So this is the central idea of hedging, and the reason you can't go beyond these limits of zero and the initial underlying position is because the objective of hedging is to reduce risk. Okay, if you have a very bearish view on crude oil, let's say if you have a long underlying position in crude oil, but you have a very bearish view and your long position is only 25,000 barrels, you can't sell like 70 contracts here. You can only sell a maximum of 25 contracts, because if you sell 70 contracts, then you'll go net short. That means you have again increased your risk. Okay, so the objective of hedging is to reduce risk. Okay, that's why the static hedging program is a more classical form of hedging, in the sense it is very clearly always reducing risk. Is this clear? Whenever you're running a static program, means the risk is always being reduced. It is never, either it stays the same or it reduces. It never increases. Whereas in a dynamic program, you can initially, that's why I said the hedger is one whose first transaction in a financial market will reduce risk. That is to take care of the dynamic programs, because in a dynamic program, the second transaction may not reduce risk. It may again increase risk, right? Relative to the way it was. Is everyone clear? Okay. So the more classical way to think about hedging is to think about a static hedging program. So that is why I've tried to teach you by and large with the example of a static program, but then in your project I'm giving you the freedom to apply a dynamic hedging strategy if you want to. Okay. So what we were saying is, and that is because you have to understand, so that two things you have to understand, that the objective of hedging is also to reduce risk, because many real life cases of disasters in the corporate world, because these simple principles were not being followed, because people are not disciplined. That's the problem. Most of the problems in life happen because of lack of discipline, whether it's in your behavior inside the class, in the corporate world. People lose sight of what the guiding principles are. Essentially, that's just nothing but like discipline. You should know what you have to do, and people lose sight of it because they get confused. And there's some real disasters. I told you about the JP case, 6.2 billion or something they lost on. You can read it up, the London whale case. All right, I'll just put that note in your. Okay, risk management disaster. Okay, I'll also tell you about this YouTube link. Okay, there's another market, very famous fund manager, very successful fund manager. You can listen to his talks on. So I've given you the video. I'll just explain this. So JP Morgan London whale. You can read up on this. I'll try to actually Risk management disaster. There are many such disasters. In fact, if you read, I would suggest you read the end of your Hull book. Your Hull textbook at the end has, I think, a little bit of, there's one chapter, you'll figure it out. I don't remember the exact name of the title of the chapter. But towards the end, there's a chapter which essentially deals with risk management disasters. Okay, so it lists out, gives you a lot of little caselets on what actual disasters happened because people were not able to manage risk properly. So I would do that as a reading, okay? So please take that as a reading. Whale risk management disaster plus, so I'm giving you this as an official reading. Hull bookends. Bookend actually has a different meaning, but I'm just using it in a loose way. Again, risk management disasters. Please read this chapter, okay? This is just general reading, just to get yourself familiar, because you need to know about all these histories. Okay, is this clear? If you have a problem finding this, please let me know, then I'll explain that to you. Okay, next one is basically this very famous investor called Stan Druckenmiller. There's a long interview. Okay, so I'm just giving you this name so you can look out for it. Somehow it's not loading. So the name is Stan Druckenmiller, very, very famous investor, global macro, also an equity trader. He's now, again, here's another example. I keep telling you about why it's so difficult to have a standard predictive model which will help you throughout the years, because unlike, say, hard sciences, like once we have cracked the science of flight, now we don't reinvent the wheel, okay, because we just follow those principles and the plane will always fly, right? So there's a big difference between hard science and finance and economics. So even see, Druckenmiller is a very, very famous investor, one of the most successful investors of all time. But about 3-4 years, I think, back, he started to lose money, and now he's gone to a situation which has happened to many famous traders. They have returned all OPM. What is OPM? Other people's money. They're all billionaires, so they have enough money of their own. They've returned all Soros. Happened to Soros. This guy also traded for Soros. So these guys now, because their performance was falling, okay, it was quite unimpressive, and they were losing money. Investors were pulling money out of the fund, so they basically they could not handle the I guess the poor performance and the lost damage to their reputation. So they've returned all the OPM, and they're now managing their own money as a part of a family office. You know the concept of family office? Yes. We have some of that in India as well. So when you have a very rich family, they will actually put their assets and they'll put in a small team to manage their assets. Okay, that's called a family office. You have that in India also, all right? So so that's the idea. So now Druckenmiller has also set up a family office kind of structure, just like Soros. So this is the problem that you see when you look at the great investors. Many of them have hit hard times, and then they've been forced to return OPM and just manage their own money. All right. So this is the problem. You see. This is why I say that markets are very, very hard to predict. That's why risk management becomes the most important goal. So you play very good defense, and then if you get some opportunities, you make some money. It's a very conservative approach, but it will sort of keep you alive. All right. So that's another point. So that's another person that you can read up, or you look for interviews on YouTube and all. You learn a lot about how to analyze the economy, especially macroeconomic analysis, even sectoral analysis on equities and things like that. Okay, so we can close this now, right? Okay, I've given you that link. Now we go back to what we are supposed to discuss. What is our next topic? Next topic, hedging. Okay, hedging for speculators. Now, so what I was saying is that this concept of hedging, okay, so what is the basic concept of hedging is that you always start with some kind of underlying position. Okay, so the concept of hedging is another word that is used, you'll notice, and a lot of people use it very casually. Okay, they don't really understand it. So hedging means, but the classical understanding of hedging will be that there's always going to be an underlying position which you, for whatever reason, you can't touch. Are you following what I'm saying? Yes. That's always going to be the setting. That's the only time that the concept of hedging comes in, because you can't touch the underlying position. So you have to set up a parallel position which will try to offset, but you're not able to touch the underlying position, but you are concerned that there will be some losses on the underlying position. Okay, that is typically the framework of all hedging situations, and that's why, because you can't touch the underlying position, what you do is you set up a parallel hedge position which will behave in such a way that when the underlying position loses money, the hedge position will make money. Is this clear? This is the basic idea behind hedging. Okay, so the problem and this question of hedging only arises when, for some reason or the other you're not able to touch the underlying position. All right. So like here you have a situation where you have this balance sheet, you're running a mining exploration company. You can't just force your sales team to quickly make these sales so that we don't have risk on the book. They can't operate like that. They have a normal selling cycle, so they will have to operate according to that selling cycle, and that causes the company to be exposed to some risk. Okay, and you have to manage that risk separately. You can't put pressure on the sales team to change how the business operates. You should not disturb how the business operates. That's another principle of hedging, that your hedging activity should not put pressure on the business to change its manner of operation. Right? Okay. So what were we saying? Okay, so now what happens is, because, okay, why does this always become heading? Now when you look at speculators, now this is an example of a speculative book. Here's an example. If you have positions in all these contracts, that would be a speculative book, right? Okay, that would be if you just have these positions, nothing else. I started with a zero risk position, and then I went and bought all these futures contracts. Okay, so imagine that I'm not going to do any trades here because I want to keep the account clean. Okay, so but if I imagine that I bought a little bit of crude oil, a little bit of gold, a little bit of copper, a little bit of euro dollars, and bought some dollar yen, bought some Aussie. Okay, Aussie and dollar, Aussie and yen futures. Okay, then you have a bunch of positions, right? I get 10 contracts here, 5 contracts here. So then you are looking at my risk book. That's an active risk book. Okay, because I started with zero risk. I didn't have any, I'm a speculator, I didn't have any risk to start with. I had money in my account, and I decided to take views on the markets, and I took a whole bunch of positions. Is this clear? Right? Now this is, now the problem here the difference is that if I, let's say if I have a bearish view on crude oil, if I feel at this point crude oil is not, I'm long crude oil and it's not going to go any higher and it's likely to drop. Okay, the easiest thing for me, if I'm a speculator, the easiest thing for me to do is just to sell crude oil. If I feel the market is going to, I'm already long, okay, and I should just exit my long position. If my view has suddenly become very bearish, the easiest thing for me to do is just sell it, because that's a simpler situation. Just sell it and then wait until, if you are only going to go long, go trade from the long side, then in that case you can wait until it goes back down again, okay, and then you can buy it later, or maybe you can after a while. So the point here is that when you're running a typical speculative book, it's much simpler to just close the underlying position. Are you following what I'm saying? Because typically these speculative books are always in the form of financial market contracts. When you speculate, what were you doing in your first project? NSE stocks. Okay, so you don't actually go and the easiest way, if you have a bearish view, is when you're already long, the easiest way is to just sell it, right? Just 2 clicks. You can just sell it. It's much simpler. Then you're back to a square position, right? So therefore, generally speculators, if you are a general type of speculator, okay, in the class, in what we would call later on alternative asset management, the general framework of speculating, you don't normally worry about hedging, because you are just going to, if you have a different view, you are just going to square the position. Okay, if your current position and your market view are not matching, you will just square the position. Is everyone clear? That is the logical thing. That's what you would have done in your project, right? I told you what happens when you're squaring your option positions. If you were long some puts, okay, if you were long some Amazon puts, and you felt that the stock price has dropped sufficiently, and the IVOLs have also dropped sufficiently, now you feel that IVOLs are going to rise, the underlying asset price is also going to rise, you would have just bought back your put. Right? That's what you would have done. That's how you normally speculate. So in general, we don't have a requirement for hedging as a speculator, but there are certain cases. So you should be aware of how you can apply this concept of hedging to even active risk books. Okay, so we need to be aware of that. Okay, so here's what it is. Now you've already seen this situation before. Okay, think about what we discussed when we talked about. This is all in part of your risk management note. I put everything together. Okay, that remember we discussed this point about directional moves in the underlying and the VIX. Okay, right? So this was also one of the questions. Very few people were able to answer it satisfactorily in the exam. Okay, or maybe not even 5 people were able to answer it satisfactorily. Why does this happen? Okay, so we said that there is a general tendency which you see. They try to show you this thing here in this SIBO page, right? That when the S&P goes up, the VIX goes down. Okay, so why is this happening? So what the question was really on, the second part of the question was, why does this happen? What is the logic behind, what is the theory behind this relationship? In the first place, this is not a guaranteed relationship. Okay, and you can't also guarantee the magnitude of the relationship. It keeps shifting. All right, so but it's a general tendency that people expect in the markets, people expect this, that if the stock market is going to fall, the VIX is going to rise. Okay, the VIX is the index of eyeballs, right? Okay, so if that is the case, why does it happen? Now I've given you the reasoning here once again. All right, so why does this happen? Because now this is where you understand the concept of hedging. All right, so if you see here, traditional asset managers, did I discuss with you guys that traditional asset managers are long only and they play in stocks and bonds? I think we discussed it briefly in IPM. We didn't have a full discussion on TAM versus AM, but we discussed a few points about traditional asset managers. So your traditional asset managers are the mutual fund managers. The bulk of the money worldwide is still being managed by these traditional asset managers. So all your mutual funds, HDFC mutual fund, okay, whatever else, you know, any other mutual fund, Franklin Templeton, whatever fund you're looking at, whether it's a debt mutual fund or it's an equity mutual fund, they are both what we would call traditional asset managers, most of them. What are some of the characteristics, not all. Some of the characteristics of TAM and traditional asset managers, we just call them TAM, is these, okay? Long only, equities and debt only, no currencies, no commodities, no real estate. This is one of the reasons when you see, if you talk to some of your colleagues who are doing, some of your friends who are doing MBA programs elsewhere, you will find that most of the SAPM texts, the IPM texts and all that, most of the finance electives tend to focus on stocks and bonds, okay, equities and debt, because that has been the traditional approach to asset management, okay, where it is to be long only. And so most of the frameworks, most of the syllabi are constructed around a long only approach to equities and debt. Okay, but I have taught you from a more general perspective, because that is the more general perspective. So you should always understand the more general perspective, which is we looked at all the possibilities, we looked at all the asset classes, because all markets are the same. Okay, there are many similarities between all markets. So therefore we covered currencies, commodities and real estate as well. Okay, at least you understood the framework. And then we have we prefer to operate with the framework which does not force us to be long only. The correct way to learn asset management is to go with a general framework, which means you can operate in, let's put it this way, there are many constraints between traditional asset managers and what is happening. This is not okay. Yeah, if we put this, all right, so if we go back to this framework, we can quickly understand what is the difference between TAM. But did I discuss AM also with you, alternative asset management? I only discussed TAM. We didn't have that. I know that I didn't do that full module because we didn't have the time, but I discussed this aspect of TAM, right? That is long only and stocks and bonds, right? So, and benchmarking also I discussed, remember? Relative benchmarking, but that is the HDFC mutual fund will be benchmarking against the BSE 200 index. So the BSE 200 index is down 40% and the HDFC mutual fund is down 30%, then they've done a great job. So minus 30%, I've done a great job. So that's the way that traditional asset management works, all right? And that's how it still continues to work. So that you should, I think that much we covered, right? These things we covered. And that's where the distinction comes between, if you look at how you were evaluated in your projects, we looked at absolute return, but risk adjusted, right? Divided by the drawdown. Your total return divided by the drawdown. So that's actually, there you don't get any, you don't get to say that, well, the market was down, okay, so therefore I lost money. You don't get to say that. So here you're supposed to, if the market is going to go down, you're supposed to go short. You should be smart enough to see that the market is going down and you should be able to go short. So whatever happens to the market, you should be able to make money. So the alternative asset management paradigm is essentially that you have to be able to make money whether the market is up or down. So you don't get to benchmark against any relative benchmarking system, right? You don't get this benchmark, asset class specific benchmark, okay? You don't get to do this in the general framework of asset management. This is the benchmark that you have, okay, in the traditional, in TAM. But the more correct approach to asset management is that you have the, it's a much broader approach, okay, which means you can go into equities, debt, currencies, commodities, real estate, anywhere, okay. And so if you see this, do you realize that this is a much broader approach and much more general approach? Okay, so traditional asset management, what does it do? It operates, basically it operates here, right? It operates, can you see the debt row? Can you see the debt row? Yeah, okay. Here, this is basically where it operates. These two places. Okay. Traditional asset management operates in these two cells. Okay. They trade in spot because they also have restrictions on using derivatives. They also have some restrictions on using derivatives to speculate. All right. So this basically where traditional asset management operates. Most of your mutual funds, they are basically operating in the spot markets. Okay, because they are fully funded. They are paying for the position very quickly within T+2, and then they are operating only in equities and bonds, equities and debt. Should always say debt, not bonds. Okay, so here I should say, in fact I should change my labeling. Instead of just writing bonds, I should write bonds and bills. Okay, maybe I've given a link to something, so then in that case I don't want to disturb it, but this should be read as bonds and bills, because bonds are bond market instruments and bills are money market instruments. So we'll discuss that classification later, but the correct entry here, I don't want to disturb it because this is a hyperlink. All right, so is everyone clear now how you understand traditional asset management? They operate in these two cells only. Yes. So now what I'm saying is that now again I'll have to deduct marks for Bharat and you're chatting between yourselves.
Most of you are making notes.
No, you are not making notes. I'm pretty sure you're not making notes. I'm pretty sure you are not making notes. No, you are discussing something between yourselves. Garotra not notching up some high scores in this course. Okay. She will be given woman of the course, like man of the match. You'll be woman of the course. Okay. All right, guys. 1 sec. Let's get back to work. As soon as I start discussing something else, everybody goes into their own discussions. Try to understand what I mean by a general approach. Ritesh is already looking at the clock. So, okay, guys, try to understand the concept here. Okay. What I'm saying is that traditional asset management is a very restrictive approach because it operates only in these two cells. Okay, they only go long, and plus they have other restraints like long only. Okay, they're going long only. They use relative benchmarks. Okay, so which means a money manager can say index is down 40%, I'm down 30%, so I did a great job, which is kind of stupid if you think about it. No investor is going to accept, but people do accept that. Okay, because there's a lot of money in TAM. So what I'm saying is that AM is alternative asset management. Okay, alternative asset management is a much more general framework because in that you can operate in any of these asset classes. Okay, you can operate in any of the instruments. Okay, are you seeing the flexibility, the freedom, the extra freedom? You can operate in any of these because here these guys are not allowed to use these for speculating. Okay, they are not allowed to use, the TAM fellows are not allowed to use this. So here you can operate across the spectrum. You can go into any of the current asset classes, you can go into any of the instruments, and additionally you can be long or short, which is what you guys have done basically in your projects. If you see, we have allowed you to both go long and short. Is this clear? Yes. So are you able to see that the alternative asset management approach is more general? You understand what is a general case and a special case? In mathematics, you didn't do general cases and special cases. So suppose you have a function that can take both positive and negative values. Then you write another function with a similar, you put a constraint on that and you say this can take only positive values. So we would say the second function is a special case of the first function because that can take both types of values and this can take only positive values. Are you following this terminology you might have encountered in maths? It's a special case of that function, right? Are you following what I'm saying? So what I'm trying to show you is that the AM approach is more general and the TAM approach can be seen as a special case of the AM approach. Because here you are able to eat, it's like you're able to eat any kind of food, and then suddenly I put a restriction on you saying you can only eat Italian food. So that's a special case of a broader permit where you would have the permission to eat any kind of food. Are you following? So this is what we mean by a general case and a special case. Okay. So the AM approach is more general. Okay, you can remember it with respect to this framework, that you can pretty much go anywhere in this framework. You can go to any asset class, you can go to any instrument, and you can go both long and short. Yes? Yeah.
So we can realize that TAM can be derived from AM.
Yeah, that's what we are saying. The TAM that's actually another way of saying it, right? So the TAM is a special case of AM. So you can just look at it as a subset of AM or whatever. Okay. So that's what I'm trying to say, that here in AM you have much more flexibility. Okay, much more flexibility, and you have the additional burden of now you're going to be evaluated against your absolute performance. You have no excuse for saying that, okay, if I were a crude oil trader, if I've been given some money to manage in the crude oil market, and the crude oil prices were down, let's say in this period the crude oil prices were down sharply, you don't have any excuse to say that, well, the market is down so much and I'm only down a little bit less, so I did a great job. No. If you're an alternative asset manager, you have to make money in both up and down markets, because your benchmark is always an absolute return benchmark. Is this clear? Okay, so that's why you'll see there are some magazines called Absolute Return, which are basically dealing with the alternative asset management industry. That's why they have these kind of names. So Absolute Return, because it's not a relative return. Why Absolute Return? Because it's not a relative return. Yes. So here you can see these are relative benchmarks here. When you say what is meant by a relative return, that is, I'm managing the HDFC mutual fund and I am benchmarking against the BSE 200 index. So my performance evaluation is relative to the BSE 200 index. It's not some absolute figure. Okay, it is only relative to that. That's why if the index is down 40% and I'm down 30%, I can say I did a great job. Okay, because my tracking error is actually, I don't have any tracking error, it's actually positive. All right, so I've outperformed the benchmark. That's what they say, right? So that's what is meant by relative returns. Okay, so now what we were trying to show you is this, just to get a quick recap of this. Also is part of your important part of your understanding, because I remember you asked some question earlier, Kushbu asked in some of the earlier courses about mutual funds and SIPs, right? So one of the things you can understand about mutual funds is this is where they belong. They are a TAM approach. Okay, typically they are a TAM approach, so you can see it in terms of this framework. Okay, and remember that the other constraint that they have is long only, right? They are only from the long side. They usually don't go short. You can see how difficult it is short in the Indian equity market. Is this font big enough right now, Puneet? Can you see? Okay, it's not big enough. Okay, because I just made everything small to fit into this. I think we don't need this framework anymore, so I can increase this a little bit. Is it okay now? Yeah. Okay. So what was I? So remember, long only. So I'll answer her question about the SIP also. Now, first thing you have to understand about the mutual fund is that this is where it goes. Okay, this goes here. The mutual funds go here. Okay, could be a debt mutual fund. So they are TAM. They are a TAM approach. So that's why the importance here is that you have to be aware that there is a broader approach available, which some of the money managers use, some part of the industry uses. Okay, most of the money in the world is still being managed under TAM, but there is now the money under management and under AM is also growing. Okay, so this is what you have to understand, that there is another approach possible. Okay, which is the AM approach, which is much broader. Now, what is an SIP? Essentially, that is just, it's like, imagine that if we have this as a so remember, these guys have to be long only, right? So if we just call this the Nifty, let's say, right? So now mutual fund you have understood. Now SIP is, what is the full form of that? Systematic investment plan. So what these guys want to do is basically they want to get you into this framework. So you have to also understand that if you're investing in mutual funds, that means you're endorsing this kind of framework. You're endorsing, it's like saying that I'm happy with eating only Italian food. I don't want to have the flexibility of eating all kinds of food, and I only want to be long on the long side. All these philosophical features, the features of TAM. If you invest in a mutual fund, that means you're giving a thumbs up to all these conditions. That I want to be long only, I want to be in equities and debt only, I want to be evaluated, I want my money manager to be evaluated against the performance of the benchmark, the stock index. Yes, that means are you following what I'm saying? If you invest in a mutual fund, you should be clear about, because I don't think people think about all these things. Okay, that essentially what you're doing is, if you're investing in a mutual fund, you are endorsing their investment philosophy, right? You are giving a thumbs up to all these conditions, that long only, benchmark evaluation against the relative benchmark, the index benchmark, right? Another index you can use is, if you're managing a mutual fund in India, you can use the Nifty 50 also as a benchmark. All right. So performance evaluation. So the Nifty is down for whatever reason, then you can't tell your money manager, well, you didn't perform, you didn't produce a return, because he's going to turn around and say, well, the index is also down. Right. So that means when you put money into a mutual fund, you are endorsing all these philosophical elements of traditional asset management. This is clear. Okay, so here's where the SIP comes in. So one of the elements of the TAM philosophy is long only, right? So what they want you to do is, remember, that's why they don't say systematic disinvestment plan. So they want to get, this is a way for mutual fund managers to build assets. Okay, they want to, what do mutual funds managers want to do? They want to build assets, right? Because another notice, I think what I'll do is I'll put this other thing also. Since we are having this discussion, we are just going to, at this stage, we will just PC is very slow actually, maybe because I'm consuming too much memory. All right, okay, what is it that we are looking at? TAM versus AM. All right, let's look at this. So, how do these guys get paid? How do mutual fund managers, how do TAM people get paid? Compensation. No, commission is for brokers. We are talking about asset managers. So the HDFC mutual fund, or Franklin Templeton mutual fund, or Fidelity mutual fund, the manager is not going to, the fund is not going to be paid on commissions. The commissions are for the broker. Okay, the commissions are for the broker. Is everyone clear? Yes. The commissions are for the broker who sells you the fund. The fund manager, I'm talking about the compensation of the fund manager. Okay, how are they getting paid? Here. So I will put this framework also so that we can cover quickly all the elements, so you can understand there are many distinctions between TAM and AM. We will cover at least some of them. Okay, so let me then put this. So what I'll do is, we have covered this part, we have covered this part, we have covered this part. Okay, then we have covered the benchmark part also, right? Then the other part is leverage. Will come to that. But that essentially, this is that you can't use any leverage in traditional asset management. That's why you see these guys are always here. You see, why are these guys always here? What happens in a spot transaction? You have to settle it pretty soon, T+2 pretty much. Sometimes T+1, sometimes T+3, but pretty much around T+2. Okay, so you have to settle it very quickly, which means if I buy 100 shares of Facebook, I have to buy at whatever the price of Facebook is per share times 100. That amount of money I have to shell out in 2 days. I have to shell out that amount of money, right? And take delivery of the stock, right? That's how it works. That's why essentially the reason these guys operate in spot markets is that part of the big part of the reason is because here you don't get to use leverage. So you have to quickly take delivery of the asset that you bought, right? And then you hold on to it. Right, so that's why leverage is not allowed. Okay, in some technically the broker will allow you to take a loan to fund some of that purchase amount, but under the framework of traditional asset management, you should not be using leverage. If you're using leverage, you become a hedge fund manager, like an AM manager. You go into this other box. Okay. Yes. So yeah, yes, Mehak, what is the question? Mike. In her case, we have to force her to use the mic. Yes. Yes.
What happens in debt mutual fund?
Same concept, exactly the same. You have to buy the bonds. If you're managing a debt mutual fund, you will have certain parameters, but essentially you'll be operating in the bond market. You may buy some bills also for short-term investment if you think the yields are good. So you're buying across the entire yield curve. Okay, what you have here, I think this particular link, what is this link here? This is just the chart of the Indian 10-year bond rate. But anyway, the point is that the yield curve that you have, okay, you can buy across the yield curve, okay, you can buy all kinds of bonds and bills, but the philosophy is the same as stock mutual funds. You are looking at your assets now, you're looking at only within the debt asset class. You're only looking here if you're managing a debt mutual fund. You're only in this asset class and you can't go beyond this row and this column. You can't go beyond this. So you basically, instead of buying stocks, you buy bonds. And again, you take delivery very quickly within like roughly 2 plus 2. And then you sit on the bonds and you're paid out the cash. And you're not allowed to use leverage. Same concept, exactly the same. Yes? Is this clear? Okay. So now, where does the SIP come in? Now, here you have to understand the concept of, you have to understand how the business works. Okay. Which is, benchmarks you have already understood. Leverage is also clear now.
Yes.
You're not allowed to use leverage because you have to fully fund the position.
Yes.
Okay. Now look at this point. Compensation. How do mutual fund managers get compensated? Percentage of AUM. What is AUM? Asset under management. Okay, so when you assets under management. Okay, when you buy, have you heard of this concept of expense ratio?
Yes, sir.
So one of the ways you rank mutual funds is some of these Indian sites like Money Control and all, and even in the US, you'll get opportunities. Those who cover mutual funds, the websites who cover mutual funds. One of the options they will give you is to rank mutual funds by expense ratio. So I'll mention this here. Expense ratio. This is an important term. So the expense ratio basically is the guy's compensation. Right? So whatever is the fund, like if you have a 2% expense ratio, right? That means if I'm a manager charging a 2% expense ratio, right? So if Tarun invests money in my fund, if he invests $100, he's only invested actually $98 because the $2 I take. Okay? So if I have a 2% expense ratio means he gives me $100, but I write it down as having invested only $98. I owe him only $98. So 2% I've straight away taken off. Okay, that's my commission. Okay, that's a per annum commission. I mean, we don't call it a commission actually because the commission is something that we use for brokers. Remember, brokers are functioning as agents. Okay, brokers are functioning as agents, whereas here, if I am a money manager and Tarun is investing in my fund, we are both acting as principals. There is no broker in between. But if my fund is being sold through a, say, Standard Chartered Bank, then the Standard Chartered Bank salesman will collect some commission. He is functioning like a broker because he's acting as my agent. He's acting as my agent and he's representing me before investors like Tarun. Is this clear? To investors like Tarun.
So that commission will be paid by by you or by the...
No, that also is paid by, that is also paid by him. That is also paid by him. That's why if you see what SEBI is trying to do, SEBI had put some commission caps and all that. See, this is where the scam is. This is where the scam is because the brokers have an incentive. It's the same problem with the insurance sales, all the ULIP plans and all that, because they had very high commissions, 6% commissions and things like that. So the higher the commission, the greater the incentive for the broker to sell the product, right? Because the more I sell, the more I earn, right? So therefore, this is where you lead this. This leads to this problem of mis-selling. You heard of the problem of mis-selling? Okay, we should just write this. It doesn't really fit in here, but I'll just write it in your notes here so that we can cover it as a separate topic. This is an important regulatory topic. Okay. Are you following the discussion so far?
Yes, sir.
So everything, like the Warren Buffett's partner in money management is a guy called Charlie Munger. Okay, you can read up on Charlie Munger. Has some very interesting. There's a famous talk that he gave at Harvard on the basic psychological frailties that investors have. Most human beings have these psychological frailties, right? So Charlie Munger says that show me the incentive and I'll show you the crime. Okay, so all crime is because human beings, this is the only law of economics that always works, that human beings respond to incentives. Okay, wherever you can make money, that's where you'll go. So this is basically what happens. You have to understand where do all these problems of mis-selling come from. Okay, so some mis-selling. Mis-selling means essentially selling a product which is inappropriate for the investor. So you take somebody who is a very old, maybe 75-year-old person, and you take all his life savings and you put it into a high-risk stock fund, like a growth stock fund. Growth stocks are more risky. So you take all his money and you put it into a growth stock fund. Okay, so mis-selling essentially is selling inappropriate. I think I'm spelling it wrong, but anyway, let them correct it. Okay, selling inappropriate products. That is, selling a product which is inappropriate for the investor. Okay, so here basically let's clarify this. Investment products. So who do you sell investment products to? You sell it to investors, right? So mis-selling is a regulatory major regulatory issue in many jurisdictions around the world. So you should understand it as a finance professional. So mis-selling, and this is very rampant in India. We had a lot of problems with these insurance plans, the ULIP plans, which were sold to people, and the commissions were so high that even after the market has risen so much, the people are still underwater. The investors are still underwater because the commissions are so high, right? So obviously, if I take straight away, I take 2% off. He puts in $100, and I actually invest only $98. That's much harder for him to make money because I already reduced 2% of his return, right? So therefore, when you have higher commissions, it's harder for investors to make money. So the main idea in this is that you're selling inappropriate investments to investors. You're taking a 75-year-old man, retiree, and you're taking all his life savings and putting it into a high-risk growth equity fund, which can lose money, right? So that will cause financial problems for the investor. So there are all these suitability when you're selling. The ideal regulatory guideline is that when you're selling products to investors, some of you may face these problems. If you go into, some of you have been hired into banks, and you may be in a selling position, okay, in a situation where you have to sell products. So in that case, you may face this kind of problem because there's some regulatory constraints. Okay, SEBI tries to cap the commissions, but the problem here is basically deriving from the incentive, because the salesman is making a commission. So now if you think about it, now suppose I'm the salesman, I've sold this inappropriate product to a high risk growth equity mutual fund to a 75-year-old retiree, right? And I put all his savings, I've been induced him to invest a huge amount, okay, all his life savings. Now, after the market, after the investment is made, if the market drops, do I have a problem? No. I don't have any problem because I've taken my money and run, right? I've collected my commission and I've run away, right? So the problem is with the investor. He has a problem because he is losing money, right? So this is the problem. So basically, this is the problem of the whole problem starts from this kind of incentive. It's a perverse incentive because the broker has no stake in the investor's gains. Okay, so this is what gets corrected in to some extent, not exactly, to some extent, but to some extent the idea is in AM. You will have to make, you get most of your compensation is supposed to come from a incentive fee, and there are some money managers who only charge an incentive fee. They don't charge a percentage of assets managed. But in AM you have two parts of the framework. You have this percentage of assets managed, you get some of that, but you also make an incentive return which is 30%. Some people charge 30%, 25% of the profits. So in AM what is going to happen is I'm going to charge a percentage of AUM as well, okay, and then I'm also going to charge an incentive fee. So here we feel that the incentives are more properly aligned because I only make money if I'm charging, like if you take some extreme examples like Paul Tudor Jones, another example of a trader who was very successful but had to eventually return all OPM because he's very little OPM now they're managing because the performance is not good. Okay, so but the point is that there's an incentive fee. This Tudor Investments was never charging any AUM, any percentage AUM. They didn't have this charge. They only had the incentive fee. Okay, let me just put that in bold because that is the distinctive part of this framework. This is the distinctive part of what is happening. There's a lot of disturbance happening still. Is there some problem? Okay, there's a lot of movement happening here. I don't know why there's some movement happening here. Okay. All right. Be quiet now. Understand this. Has everyone understood the incentive fee? If you understand the incentive fee is a pure example, if you take the case of Tudor Investments, okay, very historically very successful fund, they never had an AUM percentage, AUM based kind of fee. They never had a fixed fee. So they only made money if the fund made money, and the deal was that if the fund makes money, then so usually it is 2% of assets, the standard in the industry. You can have variations. 2% of assets under management, 2%, okay, which is the example I gave you here, same as expense ratio, plus 20% of profits. So if I produce 100 million of profits for you, I will take 20 million. Now you see in this scheme, at least theoretically, the alignment is better, the incentive alignment is better, because I don't make money unless I make money for you. And Tudor Investments is a pure example of the classic example of a pure alignment of incentives, because they never had a AUM percentage AUM fee. Okay, this is called a management fee. This part is called a management fee. This percentage of AUM, this is the management fee, and this is the incentive fee. Okay, so these guys never had a management fee, so Tudor Investments would live and die based on the performance, because they wouldn't make any money unless they made money for investors. This is clear? Okay, so these are the different ways of, now try to understand this whole concept of SIP and what kind of incentive problems it creates. Okay, which is that now what is happening, now you have understood the compensation system. So everything, as Charlie Munger said, show me the incentive and I'll show you the crime. So the problems of mis-selling come from the incentive. Okay, so why did I sell the inappropriate product to the retiree? Because I could make my commission. Okay, and that's all I care about. I'm making my commission and I'm running away, right? Now what happens? So what is this concept? So it is related to the idea of SIP. So one of the things you can see also is that if I'm a mutual fund manager, if all I'm getting as compensation is the management fee, we'll call this the management fee here, it's easier to write it. We'll call this the management fee, okay? Management fee, this is called the management fee. So even when you go to AM, this part is called the management fee, okay? And this is the incentive fee. So if all I'm getting is a management fee, what is my incentive? I want to maximize my AUM. Yes, I want to maximize my AUM. That's how I maximize my income, because that's all I'm getting, right? So the SIP concept comes from there. What will happen if you keep on doing an SIP? If you do an SIP, let's say every month you're putting in, say, 5 lakh rupees into the stock market, okay? What will happen? Your AUM keeps on growing, okay? If you're the only investor and you're investing in my fund, my fund keeps on growing. I have an assured, flow of money, and my AUM keeps on growing bigger and bigger, right? So my management fee income keeps on growing bigger and bigger. And the reason they come up with this, so you can see they have an incentive to increase the AUM, okay? And the reason they want to do schemes like SIP is because, see, people are creatures of habit. Once I put you into a habit, everybody is busy, they're doing their own work, okay? If they see, once they're convinced that, oh, I should do an SIP. Once you've done an SIP, people don't easily take it out, like once you're committed. So they put you into a habit forming kind of thing, right? So every month some money is going, you don't even have to think about it, because if they left it to you, maybe every month, maybe next month you're busy, you see some extra pressure at work, you forget to do your investment in the stock market, right? Are you following? So therefore the flow of money may not be that regular. So the idea is to sell this to investors as a SIP kind of scheme, so that you put them into a pattern. Okay, you put them into a pattern, and then, like I, for instance, every time I'm renewing my GeoFi, okay, even though I hardly use it because I'm using the fee here, the network here, okay. But the point is that once I've locked into it, it's not a very good example, but the point is that once I've locked into it, I'm not going to easily, get out of it, because let's say I have 3-4 bank accounts which I'm not really using, but who's going to go and then I have to, taking out the bank account is a headache, all this. So if you have to take out an SIP and cancel an SIP, there's also an administrative step. Like just like your phone, many people are not satisfied with their telcos, but even to do a portable mobile number portability, even to do that is a headache. So many people are just sticking with their telco because they can't afford, they don't want to take the headache of shifting, right? Same with banks. Many banks offer very bad service, but shifting a bank account is also a headache. So once they put you into the SIP framework, then the money flow is assured. And it's very unlikely that people who get into an SIP will get out. Some will get out, but a big chunk will stay in, just because people are creatures of habit. Are you following the scheme?
Yes, sir.
So this is basically a scheme where which ensures that the money keeps flowing into the mutual funds, okay, the traditional asset managers. Is this clear now? Now you understood the SIP scheme. So you may be in a situation where you're selling SIPs, but I have taught you from the point of view of the consumer or the investor, that when somebody tries to sell you an SIP, you should understand all that it means. It means that you're going to kind of lock into a kind of a program. You should also see how easily you can get out. You should see the terms of the contract, because most people don't do that, right? They may tell you that there may be a condition in there. I have not seen any of the contracts, but there may be a condition saying that you can't get out before 3 months without 3 months notice or something. So you have to read all the fine print. Okay, when are you following what I'm saying?
Yes, sir.
If I lock you into an SIP and then the condition says you can't get out before 6 months, so minimum you have to invest this much amount. You better read the contract. So this is the scheme. All right, so we'll just move on. Is this point clear now?
Yes, sir.
We'll just move on quickly. All right, so make sure that you understand. So mis-selling is in this context. All right, okay, so we have also covered in the course of this, we have also covered these points. So please make sure, I'll put this into your framework. Okay, these distinctions, some we are already covered: leverage, benchmarking, and compensation. What is the method of compensation? So these are parts of your I'll wipe this out because we have not discussed this point with you. All right, so this is what you remember, that you can, when you study this table, okay, these are the things that we have discussed with you. All right, okay, so let's go back to this the point I was saying, mentioning about what is hedging for. We only got here because of this need for hedging for speculators. All right, so it's a long discussion, but hopefully all of the things that we discussed are useful items for you to know. Okay, so now if you're long only, then what happens is, yeah, so now think of a TAM manager. A TAM manager is a long only manager. He's being evaluated against the index. All right, so if the index is going up, he may have a slightly negative view, okay, on the market, but he's also worried about he doesn't want to surrender his long position in case the market shoots up. So because, see, understand, remember, hedging works in what kind of situation? When for whatever reason you don't want to touch the underlying position. Are you following? Right? For whatever reason you don't want to touch the underlying position, only then does the question of hedging arise. Yes? That's what we discussed. So now think of a traditional asset manager who's sort of locked into a long only investment paradigm. Okay, he's also in a kind of situation where he doesn't really want to get rid of his long position, even if he has a slightly bearish view on the market. He doesn't want to leave his long position. He don't want to sell his long position. Is this clear? Are you following the situation? Okay, so this is what they do. What is the problem, SG1? What are you doing? We have to also isolate you somewhere. Don't move. You're also becoming like Garvit, always moving and always doing things to distract people. Okay. Right, now let's get back to this. So are you following here? So that the long discussion that brings you around to this idea that because the need of hedging, the question of hedging only arises when for some reason you don't want to touch the underlying position. So the traditional long only manager is also in that type of situation because he's always long, right? He wants to be measured against, he's measured against the benchmark. If he surrenders his long position and the stock market shoots up, then he will have a problem because the benchmark has gone up and his position is zero. Are you following the logic?
Yes.
So because of the investment philosophy and TAM, the long only asset manager is also in a kind of a situation where he doesn't want to touch the underlying position. Is this point clear now to everyone?
Yes.
Okay, so that's why what he would do is when he is bearish, okay, so when these guys are bearish, okay, so here what I've written down, all the logic is written down here for you, okay, because they are evaluated based on relative returns, they have a long only approach, okay, so they are biased towards holding large long asset positions even if they are worried about downside risk for the market, right? The stock market is an example. Okay, this is what I've just told you, right? So this is what I just discussed with you. This is already written over here, okay, that this basically creates a hedging kind of situation. So now what do they do? Is everyone following so far? So now if you are a long only asset manager and you're worried that the market might drop, but you're also not comfortable about letting go of your long position, what you do is now you treat your original long position as an underlying position and you buy a hedge. You put up a hedge position. right? Is this clear? So you buy. So now you decide to put on a hedge position, and you buy puts as a hedge, right? Insurance as a hedge position. Insurance, you understand? A put is basically an insurance. When your option contracts are insurance contracts, it's just like insurance contracts, right? So you're worried about the market dropping, so you buy a put, and the put serves as insurance, because if the market drops, the put will make money. Is everyone following the logic? Okay. So when long only asset managers is a fairly common strategy. So what happened now? I'll have to deduct marks for Parul. She's also moving around too much and talking.
Sir, you allowed Shubham to move now on first warning or deducting my mark.
Okay, I'll deduct Shubham's mark also. No, I have been watching you. 1 minute. I have been watching you. You are moving around too much. No. But you're talking also. You're talking to him also. You're talking to him, or you're motioning to him. You are too active. Yeah. 1 minute.
Four marks.
Yeah. For arguing, you'll lose more marks. Okay. All right. No movement. Nothing. You have to sit like a horse. 1 minute. No argument. You know you are guilty. Don't worry. Okay, don't argue. No, you are guilty. Don't worry. Okay, you are guilty. Don't worry. You have been talking too much. You have been communicating with this other segment of the class. Okay. So they are buying puts as insurance. Is this clear? Puts as insurance when you're long assets and you're buying a put because you're afraid that the market might drop, but at the same time you don't want to give up your long asset position. Okay, therefore you buy a put as insurance. So why do we have this? Is just to explain the inverse relationship between, because many of you got it wrong, inverse relationship between the VIX and the S&P 500. Because what do when they're afraid that the market will drop? They buy puts as insurance. So this is the logic. These are the logical steps. They start buying puts for insurance, okay, as a hedge. The excess demand, this creates excess demand for puts, right? This pushes up the prices of puts. Because of put call parity, puts and calls have to remain in line with each other. Price, there's a relationship. That's actually a case of pure AFV. Okay, puts and call prices cannot go out of line they are ruled by this relationship called put call parity, right? So by put call parity, if put prices are going up, call prices must also go up.
Yes.
Okay, so if both puts and calls are going up in price, rising option prices means rising eyeballs. Yes, everyone follows the logic. So this is the logic that should have been given in the answer. Okay, some of you have given it, but I think not even 5 people were able to explain it clearly. So this is the logic that explains why we generally expect this inverse relationship between the S&P 500 and the VIX. Okay, and the reason I brought up this discussion once again is to also understand that what you have learned as hedging for a passive risk book, all the hedging framework that you discussed in the entire hedging framework that you discussed with respect to a passive risk book is equally applicable to an active risk book in certain cases of active asset traditional asset managers. Are you following the logic? So the point I'm trying to say is that even in a situation in TAM where you have a money manager managing based on a long only approach, okay, and he's evaluated against the benchmark, that essentially puts him in a situation where he can't touch the underlying position, or he doesn't want to touch the underlying position. So he also operates a hedge position. He also runs a hedge kind of program, because he also puts on a hedge. He doesn't touch the underlying position, because as I said, the common sense approach, if you were running a AM portfolio, so AM is loosely referred to as hedge funds. Okay, people use the word hedge funds loosely. That is when they're referring to AM. I don't know if I've written it here. Okay, I'll just put it here. Loosely people use the word hedge funds. This is one of those buzzwords. Like now you see a lot of buzzwords in finance, which people are using buzzwords. I don't blame young people. They get easily swayed by buzzwords. But you should be wary of using buzzwords. So hedge funds is another buzzword. Many people who are using hedge funds, investment banking, many of these use buzzwords and people don't even know what they actually mean. Okay, they just use the buzzword.
Yes, sir.
So hedge fund is, yeah, we know the class is coming to an end. Okay, so the hedge funds, when people say hedge funds, what they should be referring to are alternative asset management, but the more correct term to use is AM. AM is the more correct term. Okay, so All right, 1 minute, 1 minute. No, okay, 1 minute. Let's finish this. So what we have discussed is that you can apply the concept. So the entire session has gone on hedging for speculators. Okay, that you can apply the same hedging framework even to certain types of active risk books, that is speculator books, where the situation is such because of the investment philosophy that they are put into a situation where they can't touch the underlying position. So again, the hedging framework comes into play. You can see that when the market drops, the put will make money and their underlying position will lose money. So there will be an offset. Is everyone clear? Okay, 1 minute. Let us see what is our next topic. 1 minute. Time is, we have few seconds left. Okay. In this time, decision problems and hedging passive risk books. Okay. So what we are going to see here in this module, I'll just give you a preview. You think about your decision. It's already in your notes. Okay. It's already in your notes. The discussion we are going to have is what is the question in this case. 1 minute. We have not yet finished the case. Be quiet. Question number 3 in the case, we are discussing this now. We are going to be discussing this. We are going to take the same decision problems which we are already familiar with from our discussion of active risk books, your option trading portfolio, stock trading portfolio, right? We are going to now see which of these, how do the solutions to these decision problems change in the case. Now we are back to magma. We're back to the magma balance sheet. Okay. Now, in the case of a passive risk book, how do the solutions to these decision problems change? Do they change at all? We are going to discuss these decision problems next. This is clear?
Yes.
Please raise your notes. Now you're okay. 4. Let's be clear about this. 1 second. Hedging for speculators. Yeah. So under hedging for speculators, all we are saying is that we are bringing you back. That's why I said recall. We are bringing you back to this idea we have already discussed, which is the inverse relationship between the S&P and the VIX. Okay. So first, I wanted to recap the logic for this because many of you made mistakes in the exam, right? What is the logic that creates this inverse relationship, which is not a guarantee, but it's a general tendency. Okay. Because that's the logic here. Okay. So I've given you the logic. Now, what I'm saying here is that now we are taking a fresh look at the same situation. We're taking a fresh look at the same situation, that is the inverse relationship between this and this, and we are saying that this essentially gives you an example of how the hedging framework that we have discussed, that is, you have an underlying position which you can't touch and you have a hedge position, okay, which you try to set up as an offset. This framework, okay, this framework can apply. We have discussed it only with passive risk books. Okay, generally will always apply with passive risk books. It will not apply to all kinds of active risk books, because if I'm a hedge fund manager, then I don't care about all this being long only and all that. If I'm bearish, I'll just sell. If I'm bullish, I'm buy. So therefore, the best way, if I'm bullish, if I'm already long and I'm bearish, I will just sell it. Okay, easier thing to do. But if I'm a TAM person, okay, if I'm a TAM, let's say TAM is for manager. So if I'm a TAM, then I don't want to actually just surrender my long position because the stock index might move up. In that case, the stock index goes up 10% and I have got a zero position. I am in 100% cash. So this is what these guys say, that we are moving to cash, which means you start out anyway with cash. Your whole balance sheet starts out, asset side is only cash, which is all the money the investors have put in, and the liability side is the owner's equity, which is basically the actually not owner's, it will be outside liabilities. Your liabilities to pay the investors who have invested, right? So now what happens is, therefore, now from there you move to a long position. So your asset mix changes. Some of the cash goes down, stocks come in. Now, if you are bearish on the stocks for some reason, if you sell the stocks and go back 100% to cash, and then the stock market shoots up 10%, then you are going to perform badly because the stock market has gone up 10% and your return is zero because you're 100% cash. So what we're saying is that this kind of a evaluation framework, okay, and this kind of investment philosophy, okay, they are two are connected, because the reason you have the evaluation framework is because the investment philosophy is long only. Okay, so therefore this kind of a situation puts them in these kind of constraints put them in a situation where effectively they are operating in a context where they can't get rid of the underlying they can't touch the underlying position effectively. They can't touch the underlying position. So therefore, again, the hedging framework comes into play. So you can't touch the underlying position, but still you're very worried about the stock market falling. So what you do is you put on a hedge position, which in this case, as we discussed, long puts. You can also go short futures. You can do all kinds of stuff. Okay, but we discussed the case of long puts, which applies to this situation, which helps you to understand this. So now you get another perspective on this idea. So this is a very important idea, that the inverse relationship between the SPX and VIX. So one is you understood the logic for that relationship, which is the logic that is given here. Okay, here, this logic, and then you have understood the broader context in which this kind of phenomenon develops, because the TAM guys are reluctant to surrender their long underlying position. Is this clear?
So the TAM and AM wala point and like SIP and VIX wala, that comes under the question that was hedging for speculators.
No. The idea of SIP is not connected to this particular idea. The reason the SIP discussion came up is because I took you into this. I used this discussion to also take you into the distinction between TAM and AM. So in this spreadsheet, we have discussed several points which relate to the distinction between the two, right? And then I remembered her question, because she asked that question, I think in IPM, that she asked about SIP. So I thought I would discuss, since we are discussing this point of compensation is mentioned here. So I connected the SIP question to the compensation, and that's why I pulled up the spreadsheet and discussed this point. So this last point about SIP is strictly speaking not related to our discussion about the hedging for speculators. It's a separate issue. But the reason I discussed it is because the spreadsheet was pulled up and I have covered these points. Clear? Okay. What happened? Why? Now you're laughing at her for asking a question.
No, she has not many questions.
So let her ask. So have I put a limit on people asking questions? There's no limit. So why are you discouraging her? You should not be discouraged. Okay, yes.
I'm asking that position size in US market is 100 for one contract. No.
It's not position size, it's contract size, lot size.
Yeah, lot
in the
size.
stock market, the term that we use is lot size. Yeah.
So it is 100.
100
for
shares.
one contract.
Yeah.
So
No, we don't say contract, because the stock for this kind of a situation we say lot. You can say it's not wrong to say contract, because there is a contract between you and the exchange, but the term that we use is lot size.
So why do we?
That's why we have another term called odd lot.
So why do you say that?
So when you want to buy 75 shares, that will be called an odd lot order.
Yeah, that will be 0.7.
That's why I want you to force you to use the word lot size,
OTC
so that then you can see. No, it's not OTC. This is an exchange traded market. Stocks are traded in exchange traded
can
market.
do flexible. No, you said that odd lots can be traded on OTC.
Yes, odd lots can be traded on exchanges also, but these prices you'll get worse prices.
Okay, you have to demand.
Yeah, it's because you're going outside the convention, so you will not get this price. You may not get this price. If you get it, you're lucky. You're not entitled to get this price.
So in TWS, is there a provision for that also?
I'm pretty sure. I've never traded odd lots, but I'm pretty sure that TWS will allow you to trade odd lots also.
And sir, in like we have 25,000 of crude oil. So you say always 25 contracts. So it could be 250 contracts.
What?
For crude oil,
Yeah.
we have 25,000 in
Yeah.
position. So there will be 250 contracts. No?
Because the CME crude oil contract is 1,000 barrels.
Okay, so this is different.
Let's check it. I'm pretty sure it's 1,000 barrels, but let's check it. Energy complex. You see how many different products trade there on the energy complex. See all the open interest. See how high the natural gas open interests are. Figures are very high. Lots of volume. Okay, let's look at crude oil futures. Let's go to the contract specs and look at it. I'm pretty sure it's 1,000. There you are. So that's why I said 25 contracts.
And then gold also we have 25 contracts because it's 2,500
1 minute. No, not here.
in California.
No, the spreadsheet is here, the balance sheet is here. Gold, how many do we have? Half. So there's also 25 contracts. So very small balance sheet because of the constraints of the capital.
So we don't have any odd contracts.
No, that balance sheet
We don't have odd lots and
No. The balance sheet has been constructed in such a way that you will not have any broken contract sizes. That is how I've constructed the balance sheet, taking into account the contract sizes.
yeah, because that can cause
So that if you want, you can go to 100% hedged. And the balance sheet has been kept very small because that also gives you, if you go to 100% hedge and then you start making losses on the hedge position, okay, then you will have to pay for those losses. There is a futures contract you're paying every day. So I have deliberately kept the balance sheet because knowing that my master constraint is $1 million in risk capital. $1 million in investable capital and risk capital. So that's my master constraint. So everything is structured around that. And then I put additional constraints saying in the form of the contract sizes. So that's why I've made them round lots in terms of contracts. Is this clear? That's why it's like this. Alright?